If you've been lazy about your mortgage, you are essentially paying a procrastination tax to the bank and could potentially be missing out on $15,000 in the next 3 years. Let's talk about this today. You've been watching the news and hearing that interest rates are finally dropping. And if you're stuck between deciding a floating SORA rate or a fixed rate or a HDB loan, this video is for you. This isn't just for private property owners. It's for every property owner in Singapore, HDB and private, watching the monthly installments eat away at their wealth. And it's not just about the rate. It's about how your loan-to-value, or LTV, and your loan size that decides the deal you get. In 2026, the playing field is level. Since August 2024, HDB LTV limits were tightened to 75%, matching the bank limits for private properties. But here is the paradox. In this market, sometimes the more you borrow, the less you pay.
What?
Banks are hungry for your business. While a 950,000 loan gets you 1.5 interest rate, sometimes stretching to 1.1 million can unlock better rates potentially as low as 1.35%. It also helps if you're in the premier banking program with the bank, like putting in 100,000 into one of the financial instruments. I'm going to show you why taking a larger loan is a smarter wealth move you can make this year. We're talking about a potential 15,000 net gain in just 3 years by understanding the bank's own rules. Today, we break down the double whammy effect and the math of interest rates. Why is 2026 the year of interest rate flip? Let's look at the Trump effect. With Donald Trump in the White House and Jerome Powell's term as Fed chair ending this May, the market is pricing in a massive shift. Trump is vocally pro-low interest rates, and his next likely Fed chair nominee would want to keep the economy hot. This 1.5% rate environment is a multi-year cycle for at least another 3 years to the end of his presidency term. Locally, banks like DBS, UOB, or OCBC are offering 3 years fixed rate at 1.5%. Take note that this isn't the banks being nice. If they lock you in at 1.5% for 3 years, it is because they believe the floating SORA rates are headed to even lower rates. They want to capture your loan quantum at a higher interest rate before the market bottoms out. To understand that bottom, you have to understand SORA. Unlike the OCBOR, which is based on future guesstimates, SORA is the truth benchmark. It is the average of actual borrowing transactions in Singapore's unsecured overnight interbank rates, published and regulated by the Monetary Authority of Singapore. Because it's backward-looking, it creates a predictable path down, referencing the external factors. As the Feds cut interest rates, your mortgage follows with a 3-month lag. Usually, a falling rate means a struggling economy. But we are doing this while our economy is booming, closing 2025 with a massive 4.8% GDP growth. In 2026, we have high growth fueled by low interest rates, meaning as of now, referencing the internal and external macroeconomic factors, a floating SORA rate may turn out to be lower than a fixed bank rates in the coming months or years. But why refinance now? Let's take a look at some numbers. For a 950,000 loan over 30 years at a 2.5 interest rate, your monthly mortgage is 3,754, which means 1,938 or 52% goes to interest and 1,816 or 48% goes to principal. You are in fact paying more to the bank than towards your principal amount. Now, let's look at a 1.5% interest rate. Your monthly mortgage dropped to 3,279, which means 1,159 or 35% goes to interest and 2,120 or 65% goes to principal. Even though you pay $475 less every month, you are paying $300 more into your own principal. By delaying action now, you are paying a $775 procrastination tax every single month to the bank. Most Singaporeans are asset rich but cash poor. If you have a $2 million condo fully paid up but only $20,000 in the bank, you aren't secure. You can't sell part of your property, neither can you eat your walls in an emergency. When you pay down a 1.5% mortgage with cash, you are only earning 1.5% on that money. That is a massive opportunity cost. You are choosing the feeling of safety over the reality of wealth. Even in a higher interest rate environment, if it's 2.5% or 3% depending on your external investment vehicles, it might actually make more sense to take a bigger loan if you know what you're doing. This is why our dear friend Robert Kiyosaki once said that real estate is a good debt. Let's take a look at a 3-year example now. Neighbor A takes a $950,000 loan at 1.5 interest rates. 30 years loan tenure results in a $3,279 mortgage. 2,120 principal, 1,159 interest. No extra cash on hand. Neighbor B takes a slightly bigger loan at 1.1 million and manages to get a lower interest rate at 1.4%. 30 years loan tenure results in 3,744 mortgage, 2,492 principal, 1,252 interest. Has 150,000 cash on hand. The difference in mortgage, 465. Breaking it down, difference in principal 372 and difference in interest 93. Over 3 years, neighbor B pays $3,348 more in interest. But that 150,000 cash on hand, if invested in a 4% investment vehicle, earns an extra 18,729. Now, I can hear some of you say, but Kenneth, if I take a bigger loan, my monthly mortgage is higher. I'll have less cash to spend every month. You are 100% right. In our example, neighbor B has a higher monthly payment of $3,744, whereas neighbor A's monthly payment is $3,279. Over 3 years, that's about $16,740 in extra payments you have to make. But don't forget, with a higher mortgage, it also means that you are contributing more back to your principal anyway. Out of that $16,740 extra that you are paying, 13,392 goes to your principal and 3,348 goes to interest, which was the extra interest we were tabulating earlier. The real cost here is just the difference in interest rate. Thanks to taking a bigger loan, you get to keep more of your money liquid. 150,000 in this example, and also a slightly lower interest rate. And so, if you run the numbers for these two situations over 3 years, this is what your final numbers would look like. 950,000 loan becomes 873,049 with an extra cash flow of 16,740 from getting $465 spare each month. 1.1 million loan becomes 1,009,592 with an extra cash flow of 150,000 and getting an investment return of 18,729 at the cost of paying an extra 3,348 interest. If interest rates do rise after these next 3 years, neighbor B still has the flexibility to lower his overall principal amount by dumping all of his 150,000 and investment returns, and the loan is then reduced to 840,863, still lower than neighbor A's 873,049 balance. Now that's a lot of numbers, isn't it? But the key lesson here is to take advantage of lower interest rates to perhaps allow for greater liquidity as insurance against potential life changes. For neighbor B, because he took the bigger loan and kept $150,000 liquid, even if he used that $150,000 to subsidize his own mortgage by paying that extra $465 every month, at the end of 3 years, without investing at all, he would still have over $133,000 left in his pocket. For neighbor A, where he took the smaller loan to save $465 a month, he has $0 in extra capital, less the $465 he saves monthly. And if it's a question of investing a lump sum of $150,000 from the start versus $465 a month for 3 years, the larger amount would definitely earn better returns. At the end of 3 years, the one with the larger loan amount in a low interest rate environment still wins at the end of the day. So yes, by paying down your mortgage, you will have better monthly cash flow, but you have zero financial liquidity and flexibility. If you lose your job in 2026, neighbor B with the 1.1 million loan and $150,000 in cash can survive for years. Neighbor A with a smaller loan and no cash is in trouble the very next month. This is why this isn't just a wealth strategy, it's an insurance policy. So let's put it all together into a formula you can use for your own home loan and perhaps a little interactive segment. You will have to find out 3 things. The first, loan gap. Second, interest penalty or cost. Third, investment yield or gain. Using the scenario we spoke of, the loan gap was 150,000, 1.1 million versus 950,000. The interest penalty or cost over 3 years was 3,348. The investment yield or gain was 150,000 in a 4% investment vehicle for 3 years is 18,729. Using your loan gap, you can derive your interest penalty and investment gains. And to find out your net profit, take the gains or costs, which results in 15,377 net gain in this case. That 15,000 is your efficiency profit. You didn't work a single extra hour for that money. You just simply chose not to bury 150,000 into your home and leverage on low interest rates to earn more elsewhere. Even after you account for the slightly higher monthly payment, you are still at least $15,000 ahead in your net worth. You are essentially getting paid $5,000 a year for just having the courage to manage your own money. But as you play around with your own numbers, you will have to adhere to 3 rules of thumb for 2026. Rule 1, opt for SORA rate packages that grants you the flexibility to convert to fixed rates if things take a turn for the worse. Rule 2, check the interest tier for each sum. It is usually different for above 300,000, 800,000, or 1 million and above in loan depending on bank's policies and whether you're a premier member. Rule 3. Only use this strategy if the loan gap amount is money you actually plan to invest. If you're just going to spend that extra 150,000 on a new car or luxury renovations, then don't do it. You're just taking on more debt. This formula is for wealth building, not lifestyle inflation. And just to touch on the HDB loan for a bit, we all know that HDB loan is fixed at 2.6% interest. And even though it seems relatively high now, you have to understand the characteristics of a HDB loan. HDB loan requires no attention at all, meaning it's a fixed 2.6% interest for the full 25 years. You won't have to worry about rates going up or down or repricing or refinancing. HDB is also not as heartless as banks. For banks, when you miss a few, maybe 3 mortgage payments consecutively, they can move to foreclose your house. However, HDB is that nice motherly figure that will tell you to take care, pick yourself up again, and repay back whenever you can. They won't immediately be chasing you for money. They are often way more understanding than banks and generally won't repossess your home unless you've missed payments for potentially years and made no effort in repayment. So if you want a peace of mind and that psychological support that you won't be left stranded on the street should things take a turn for the worse, HDB might be your best bet. If you want to capitalize on market movements, maximize your wealth, and you possess enough financial support and knowledge of what you're doing, then bank loans in this period might be your best bet. So in summary, current macro factors and banks are signaling towards lower interest rates, possibly at COVID levels once again. These lower interest rates will likely stay or go even lower thanks to the US president and the upcoming Fed chairman changes. And because of that, SORA is likely to perform better than fixed rates as long as the situation remains the same. It may be a good time to consider refinancing and leverage your returns in a more profitable portfolio at your comfort level. Take on flexible loan packages so that you have flexibility when things take a turn for the worse. These packages should allow you flexibility to convert to fixed rates after a year or so. Use this to free up more cash in hand, and you'll not have to worry about your mortgage in a scenario where your circumstances in life changes. Invest the extra cash and don't use it to inflate your lifestyle. And that's it. If you want to discuss more on how to maximize your wealth or need assistance or clarifications in calculations or simply do not know how to start this process, feel free to drop me a text at 9694 9000. I'm Candice and I'll see you in the next video.